Thank you all so much for joining us for the Investments, Stocks, Bonds, and Bitcoin workshop. Joining us today are Travis Scribner, Managing Partner at Westpac Wealth Partners, Tori Garber, Financial Advisor at Northwestern Mutual, and IJ Mahaisnand, Marketing and Sales Guru at College Loan Freedom. They will be helping us demystify the complexities of investing so we can be better equipped to decide when and how to invest. So I'm going to hand it over to them first to introduce themselves and give us a bit of their backgrounds. And then we are going to open it up to questions. Travis, do you want to get us started?
Yeah, that's just fine. You kind of gave the introduction. My name's Travis Scribner, Managing Partner with Westpac Wealth Partners. I am an alumnus of the University of Nevada, Las Vegas, how I always affectionately refer to it as the Harvard of the desert. So it's great to see the rest of you guys on this call here with me today. Westpac's a regional wealth management firm. We've got around 200 advisors on the West Coast, with about 50 of which of those reporting directly to me. Recently featured in Fortune magazine, Inc. magazine, fastest growing mid-sized workplaces, best companies to work for. So it's been a pretty fun ride as we've grown. I'm looking forward to helping some people that are sitting in the same seat that I was not that long ago.
Thank you so much. Tori?
Good afternoon, everyone. My name is Tori Garber. I've been running my financial planning practice at Northwestern Mutual for the past 4 years. Prior to that, I was a professional dancer here in Las Vegas and abroad for about 17 years. And I'm excited to be with all of you today. Financial planning can seem very daunting, and we're going to break it down into some, manageable concepts so that you can feel good about moving forward with your financial plans.
Thanks, Tori. And IJ?
Yeah, good afternoon. My name is IJ. I'm here in Henderson, Nevada. We're at College Loan Freedom. We mitigated about $130 million in student loans here in the Valley for people that actually brought on student loans. And about 8.5 years ago, I'm originally a SOS trader, which is called a short order execution trader, also commodities and options trader for about 20 years. And about 8.5 years ago, we got involved in cryptocurrencies and blockchain. And now we do advising, consulting for asset management in the cryptocurrency space. And we also help raise funds for North American groups in Southeast Asia. Good to be here.
Thank you all so much. It's great to have you all here. So let's just dive in and start with the basics. What is investing? Who wants to start us off on that one?
I'll jump in so we're not stepping all over each other's toes. I think it's a perfect place to start. I think the biggest thing that I can teach everyone right now and share with everyone right now is there is a difference between investing and speculating. I think when most people think about investing as a whole, they're thinking of, the Wolf of Wall Street or the different things that you see, in movies or in Hollywood or on TV, where it's, I'm going to randomly pick and choose these stocks based on, some information that I may have. A lot of that is speculation, right? Investing in itself is extremely boring. It's very academic in nature. It's very boring in nature, and it's get rich slow, not get rich quick, which kind of goes against everything in our society that we see now. And that Warren Buffett actually spoke about that years ago. He said, it's pretty easy to do, just no one's interested in getting rich slow. So I think investing, it's this academic approach to, how are you investing your money? Where are you putting your money? What are the types of companies that you're buying? What's the strategy behind those? And again, right, it's not, the Wall Street bets, GameStop revolution of speculation. There's a lot more to it, and you're playing a much longer game. I think the beautiful thing about speaking to people your ages are you've got a lot of runway left. You do have time to get rich slow, as unappealing as that may sound.
Did anyone want to add anything to that?
Yeah, really, it's just taking your money and putting it into something in the hopes that it will grow. Investing, you're typically buying shares of companies and hoping that you've picked winners so that you can make money right along with them.
So our next question is investing only for people with a lot of money, or is there a way to start investing with little money?
I'll take this one started off. So investing, it's really, a good way to approach it is where do you put your time, energy, and efforts? So it could be investing in a small business that you started. It could be investing in furthering your education, like the crowd and the organization people here. That a lot of you already have your undergraduates. You want to go through your masters, and maybe even someday we want to call you doctor or barrister or a lawyer. But particularly in this conversation, we're talking about assets, and assets being U.S. dollars typically, and you really don't have to start with that much at all. Some even simple forms of investing, such as some of the apps that just take some of your spare change from going from Walmart or 7-Eleven, they'll start put that in assets for you, even stocks that you wish, fractional share investing. But the most popular way is really just a portion of your pre-tax dollars, your after-tax dollars, and stocking that away every paycheck, every pay cycle, every pay period. And if you, like Travis said, like a lot of runway, you're looking at, say, 26 pay periods, taking a little bit of time over, say, maybe 20, 30, 40 years. Next thing you know, you may have a couple stacks, maybe a few million, maybe tens of millions. So you really can start with just really your attention, investing time in reading. We ask everyone who gets involved in any form of investing, there is inherent risk, is that you educate yourself. But if you don't want to educate yourself, lean on people like Tori or Travis or me, and maybe we can help and guide you as well, because that's what we do. So it doesn't take a lot of money at all.
Yeah, even if you're working with a financial advisor, most investment platforms will have a minimum as low as $50 per month. So that's a good way to get started. It also builds discipline, because if you have $50 or $100 coming from your bank account going into the market every month, you don't have to think about it. It's kind of like forced savings. And as the years go by, you'll read your statements and you'll be, wow, I didn't realize I've come so far.
Thank you. So we have a couple of questions in the chat. First being, do you have degrees in business? How did you get involved in the work that you do?
I've got a degree in finance with a minor in public relations. This was actually what I always wanted to do. So I'm one of those weird kids. I think, I'm going to age myself because I've come from before the internet. So I remember looking at stock prices at the breakfast table as I was eating my Cinnamon Toast Crunch when I was 11. So it was something that I always wanted to do, and then was fortunate enough to have the opportunity to pursue and to do for my adult life.
Oh, Tori?
Go ahead.
I do not have my degree. I actually went to UConn, University of Connecticut. And then entering my last semester, an insurance and a strategic hedge fund showed up with a check. So I did not go back to school. I took the check. I won't lie to you guys. I still have that money. It's grown. But like Travis, I started my first certificate deposit when I was 11 years old. I started trading stocks when I was 15. And I got my licenses. So the license I carry now, I used to have my Series 6 and Series 7, 63. So these are just trading and also other people's investments. Now I've just dropped it down to insurance licenses in 40 different states. So I do not have my degree, but right now I'm actively a part of 2 different financial economic think tanks where we lend our advice and our research, our abilities to different groups.
For me, this was a career change. I wanted to be an attorney. My undergraduate degree is in political science. And then after all of that schooling up till 22, I thought, oh, let me just take this gap year and go dance for a year in Las Vegas. Well, that year turned into 17 years. And I made that switch when, like any athlete realizes, I can't do this the rest of my life. What's going to be the next chapter? And I wanted to make a big impact. and I wanted to work with people. And the idea of going back to law school and accruing a bunch of debt when I was completely debt free was no longer attractive in my 40s like it was in my 20s. So that's why I thought this is a great way where I can get licensed over a period of months versus over a period of years and get right into that next career.
Thank you all. So our next question in the chat is, what is an asset? Is my house or car an asset?
They could be defined either way. They could be defined as either assets or liabilities. I guess it depends on if you actually own the house outright. Do you own the car outright? If there's no payment on them, then yeah, they're absolutely assets. Um, Cars definitely, a heavily depreciating asset. With a home, even with a mortgage still on it, it could still potentially be viewed as an asset based on the amount of equity that you have inside of your home. If you own a home here in Vegas that you bought 4 or 5 years ago, you probably have a fair chunk of equity based on what the real estate market has done. So in that case, yes, an asset.
Thank you. So our next question here is a bit more specific. So it is with the housing market frenzy, me and my partner were not able to buy a house, although we tried very hard, but none of the offers were successful, and we had to go way over budget. Also, I'm afraid with inflation that our cash will lose its value, and we are still looking for the house, but at a lower pace. What is the best thing to do? Should we invest our saving that we kept for buying the house since we had to renew our lease, or should we keep it?
I guess it depends on that question. If you think that you're going to go back in a year and try again, then you would not want to invest your down payment money, because if the market goes down, let's say you had 10,000 set aside for the house, you put it in the market, and then the market drops by 20%, then you're only left with $8,000 for that down payment. So if it was going to be a longer term thing, like maybe 5 years down the road, you're going to go back and look in the housing market, yeah, then maybe it would be appropriate to invest for a period of time, not a risky investment, more of a balanced investment. The other thing you can do, even though high yield savings accounts are paying, maybe 0.5%, that's still more than the 0.1 or 0.2 you're making in a regular savings account. So that way you can be making a little bit more and more of a yield, but still be able to grab it whenever you need it when the right house comes along.
I think the only other thing like that I would throw on top of that is the best advice I can give to everyone listening to this right now. Do not be house poor. Like, just don't do it. I think, as values have gone up, you see people overextending themselves to get the home that they want. Being house poor is a very, very tough spot to be in. I've got an office in Orange County. And just about everybody that we encounter in Orange County is house poor because the cost of real estate is so high. So be very, very mindful if you start going over budget. I think the mortgage companies will approve you for a much larger loan than is suitable for most people to get. So be very mindful of that as you move forward.
Comment too, in that question, and basically was a statement as well about the situation, is they brought up inflation. So though it's been a very, very topical conversation piece for literally over the last 40 years, it really in the last 15 years, we've actually seen deflation. You can see the consumer price index over the last 15, 20 years. Really, interest rates are historic lows for mortgages and overnight, which is LIBOR, for the money that banks pay for international carry. That being said, inflation really should not be a concern right now. One of the things that should be a concern is cash flow. How much you're earning, what's your earning potential. So if you're in a occupation or job, bless you all are extending your education, you should see a fairly sizable bump up in your income over the next 5 to 10 years. That being said, your buying power should be stronger. Now, with historic lows, interest rates can go up, but nothing, compared to if anyone's even out there, 70s and 80s and early 90s, where you're looking anywhere from 6 to 11, 12% inflation. So inflation, though a lot of people talk about it, if they're in the know, it's not really a concern. But the buying power of the U.S. dollar is very, very strong. So one thing you should look at is cash flow. And if you are committed to maybe a 15-year note or a 30-year mortgage, look at that. Look at maybe if you have a partner or a spouse or a loved one, the combined income earners of people with advanced degrees. That's why we're all here at the graduate program. You're in a very, very good position. And then obviously, if you have a few more dollars, definitely lean on other people that do this for a living, because this is what we think about all day long. While you're maybe serving communities, maybe while you're serving people, maybe serving your employers or yourself as a self-employed person, really lean on professionals like Travis and Tori and other people here in the Valley that really, we live in this community. We want to support it and obviously try to help you out as best we can.
Thank you all. So if I just graduated with my bachelor's degree and I know nothing about investment, where should I start?
If this stuff interests you and you want to do a deep dive into research, you can go it alone. But if you know nothing about it and you're like most people with busy lives, whether it's school, work, etc., I think it'd be worth your time to go and meet with a financial advisor. You can interview them. You don't have to move forward just from one conversation. That way you're going to get the education from them. They're going to get to know you, what your unique situation is, find out about your goals, and collaborate with you to design a plan that makes sense.
I have a question about the cryptocurrency. What's your opinion about cryptocurrency and which are the best cryptocurrency?
Take a shot at this one. So cryptocurrency is just a ubiquitous name for a grouping of financial instruments as we know them. But actually, it's a form of either transferring of an asset or holding of an asset or some form of value. That being said, the most popular ones that you hear right now are Bitcoin and Ethereum, but that's just saying like, hey, stocks, we're going to mention Tesla and maybe Walmart. Those are just two of the brands. There's approximately that are trackable about around 6,800 different cryptocurrencies. Really just do your due diligence or work with people that work in the field. I don't want to particularly say one out there, but I can just tell you what the most popular ones now are Bitcoin and Ethereum. Bitcoin is the precursor to the first one. It came out roughly 12 years ago. The technology there is super old, but it does serve a purpose. It does hold a store of value. And then the next one, the number two most popular, is called Ethereum. And that's more of a workhorse that actually you can actually build upon that more easily and frequently and cheaper than Bitcoin. So when it comes to cryptocurrency, a great way to go at it is actually just go to different resources. One is crypto.com. One is bitcoin.com. There's tons of free material out there, and there's lots of great books that are just released in the last 24 months. But know that when any kind of new form of investment vehicle, if you're going to use it as that, like I said, please do your due diligence or work with people that actually work in the field. There is always inherent risk. And with any kind of bleeding edge technology, that could be space investing, that could be material sciences, there could be home runs, but there could be pitfalls as well. So I can't stress that enough.
There are news that we may be able to use this cryptocurrency like money, digital money future. What is the real future for this cryptocurrency? It's just something virtual, or we can use it in future?
So when it comes to cryptocurrency, it's just a software package. So just like how your cell phone works, just like how your Tesla may work, just like how airplanes fly. I don't know if people know this, but airplanes pretty much fly themselves now, and pilots are really just taxi drivers that are just sitting in it. It's actually on autopilot. So almost everything that we use today, be it the electricity that we use, be it any kind of lights that we use, it's all based on software packages. So when you talk about cryptocurrency, the most popular use case is a form of money transmittance or store of wealth, but it also does things such as like voting block systems, right? It's very, very popular used in different companies for tracking voting where it cannot be tampered with. So these are just another one where it's used quite often is actually in the insurance industry for filings in the medical history filings. So this doesn't get that much because the insurance and medical doesn't really get people excited, but the technology is just a form of software. So when you say cryptocurrencies, it's a form of software that can be applicable for a myriad of different things. But as for the use cases when it comes to general purpose, just recently, Visa announced that they're actually going to use a form of Bitcoin, which is called Lightning, and the software package for that. So if you have a Visa card, there could be a chance that you're already using a form of blockchain technology. So it's a large grouping. And like I said, you know, in this very, very new age, there have been printed billionaires. People have done well, but I think the time will tell. And if you want to be more specific, depending on what your runway, your financial goals, maybe a good idea is recommended anywhere from 1 to about 3.5% of net assets into blockchain technology. So a very, very, very tiny bit. To give you an idea, some people recommend about 45 to about 65% of your net asset disposal into equities, aka stocks, bonds about 20%. So it's a very, very tiny. So you have a little bit of exposure, so you can understand it. And if you maybe have experience, maybe increase that. But that's what the recommendations are generally. Usually one. So if you have $100, try $1 or $3. It's so small.
Thank you, IJ. I did get a follow-up question on that. Someone did ask if you can spell the new form of currency. You mentioned Bitcoin and a couple of others. If you can put that in the chat, if you don't mind. And our next question we just got was, would you pay all of your debt to set yourself free or use some of your money to invest in retirement accounts, for example, Roth IRAs?
Financial freedom really is having options. So you're probably going to have debt most of your life. Whether you get rid of your school loans, you'll have a car loan. You get rid of your car loan, you'll have a home loan. You probably have some amount of credit card debt at different parts of your life. So if you waited to become totally debt free, you would have missed years, if not decades worth of opportunity to grow your wealth. So it's really a balance of paying off debt and saving for the future. And easy way to think about your money is the 20-60-20 rule. The first 20% of your income should go towards saving. The next 60% of your income should go for bills, whether that be paying off debt or just living expenses. And then if you've done those two successfully, the last 20% of your income you can spend with reckless abandon because you've done everything right. Use it on beer, use it on vacations, use it on a Maserati. Like, it doesn't matter. If you're saving and you're paying your bills, then feel free to enjoy that extra 20%. The problem is most people do it the exact opposite. They spend the first 20% on fun stuff. They make sure they get their bills paid, and then there's nothing left to save.
Thank you, Tori. So our next question is, what is the best way to learn how to trade options?
I'll jump in. So yeah, options. I mean, for those that don't know, options are just essentially future contracts of you betting on if you believe a company is going to go up or down in value, as opposed to buying the actual shares of the company itself. You're going to buy the option to be able to buy the company or sell the company with either calls or puts. Super complicated when you're getting into options trading. There are a host of resources out there. I think what's kind of cool for you guys is, you know, you've kind of grown up in this YouTube generation, and you know, with the internet, you've got kind of the answers to everything at your fingertips. What I would recommend is practicing with you can open up a practice account, so it's not real dollars. You can start back testing your option strategies to see if what you're picking and what you're choosing would have worked, and then from there, God bless you and Godspeed as you go out there and try to do it by yourself. But if you're getting into the options market, definitely spend a fair amount of time of due diligence of getting familiar and comfortable doing it, because it's not like, you know, you simply hopping on Robinhood and buying a fractional share of a stock. There's a little bit more to it than that.
Thank you. It looks like we kind of have a follow-up. Thoughts on the GameStop short squeeze?
Love it. Absolutely love it. I think it was awesome. I think you saw um, a group of young, intelligent, well thought out, essentially created a trade mob, and you know, beat the hedge funds at their own game. And I think it was awesome to see. I think it spoke to where we're moving as a society, that you know, you could band together through the internet and share information. And there was real fundamental analysis, right? When they really looked at it, right, they saw that, you know, these hedge funds were short more shares of that of GameStop than were even outstanding, and they jumped all over it and hammered them for it. And so I think it was pretty cool to see.
Out there
Tori,
for
looks like you're on mute. Oh, sorry, go ahead.
Buttons are really.
big shout out to Las Vegas really quick. So if you guys know Wall Street Bets, some of the gentlemen, some of the young ladies, there is a group, and actually a spider group here in the Valley, and they've done very, very well with some of those plays. So I want to wish congratulations to them. It's always good to bring money into the Valley. So congratulations to them. They played AMC as well. They played some other plays, but I want to throw that out there. So yeah, so good job, guys. Good job.
No, well, I think the big thing with that is like you're seeing more and more of it, right? Again, going back to what we said before, everybody wants to kind of get rich quick. I think you've got to be careful about that, because what you saw after GameStop is you started seeing a lot of pump and dump, where you'd see people talking about a company going up in value, and then the people who kind of spearheaded the rumor would sell out, and they're going to leave people holding the bag. So that's what you've got to be really, really careful of if you're, you know, dabbling in that type of speculative investment.
So, what asset allocation would you guys suggest for younger people starting out in investing?
What you can do is fill out an investor profile. It lets me as a financial advisor know how comfortable you are with risk and volatility in the market. Sometimes people that are younger and are not as experienced with investing actually won't be that risky, and I will encourage them to take on a little bit more risk because they do have more time. But you can change your risk tolerance from time to time. So I think the most important part is getting started. Uh, Typically for somebody in their 20s or 30s, they have a lot, you know, several decades before retirement. So they would want to have more of a 80-20 allocation. That's 80% in stocks, 20% in bonds. The stocks are your home runs, and your bonds are more the stable anchor of your ship, so to speak. But you know, it really isn't across the board just because someone's young. It really is important to understand what you're doing and do some type of investor profile. So when you wake up in the morning and you find out that your portfolio is dropped by 40%, you don't freak out. Like, it has to match your personality, your philosophy, so that you can, you know, enjoy life and not be stressed about your investments all the time.
We did get a follow-up question on that. Can you clarify what bonds are?
Tori, you want this one or me?
Go for it.
Uh, Stocks, I think most people are really familiar with. You own a share of stock in a company, you own a small piece of that company. I think that's the one that everyone gets. Everyone's heard of bonds. I think that's where people's eyes kind of glaze over, though, when asked to explain what a bond is. A bond is simply a debt instrument. So if a company wants to raise money without selling a piece of itself, it can issue bonds. So you'll hear bonds be either issued by companies, by municipalities, by governments. It's just a way for them to raise capital, and essentially attached to the bond is what's called a coupon rate. And all that says is, okay, we're going to agree to pay you, Tori, 2% every single year based on the amount that you've given us for this bond. When the bond matures, when it reaches expiration, we're going to give you that last interest payment, and we're going to give you your principal back. So it's essentially you as the general public acting as almost like a bank for, you know, the US government or for corporate bonds, and depending on the level of security behind them. So the US government can pay very, very small amounts of interest on their bonds, because we're seeing anything in the last, you know, couple of months as the money printer goes burr, they print some more money and they're going to be able to pay you back. So it's a very secure debt for them to be able to repay. So if they're offering 2%, and I know I'm going to get my money back, and Apple is issuing bonds at say 2%, well, I'm going to give my money to the US government because I know like there's less risk. So they've got to entice me with a higher interest rate in order for me to buy their bonds. And the riskier the company, right, the higher yield that those bonds will pay. If you look back in the early days of Las Vegas, it was actually financed by a gentleman by the name of Michael Milken, who issued junk bonds. And that's essentially how Vegas came into where it is now. So junk bonds, super risky, high yield bonds that pay a lot of interest if you hit the right ones.
Thank you. So our next question in the chat is, what are y'all's thoughts on automated investing accounts?
Does that just mean like they're pulling a certain amount from your bank account every month? Is that what they mean by automated investing accounts?
I believe so.
Andromeda, do you want to clarify more on that question?
She said, sure.
Are you talking about
Okay.
Acorn? Are you talking about systems like Acorn? Is that familiar to you?
I tell you what, automated investment accounts are great. I think everyone here, for the most part, is familiar with it. A 401k is an automated investment account, right? It's money that's backed out of your paycheck every 2 weeks. It goes directly in. It is prepackaged discipline. I think automated investment accounts are absolutely fantastic because you're not left to your own devices. I think, speaking to what Tori said earlier, that 20-60-20 rule, paying yourself that 20% first becomes far easier if it's an automated process. And I think, you know, the easiest way to do that is with your 401k, but you can do that with any other, you know, investment account or advisory account where you can just set up systematic withdrawals to come out every month.
Yeah, you may end up working somewhere that doesn't offer a 401k. A 401k is simply an employer-sponsored retirement plan. If you're working for an employer that's maybe smaller or a startup and they don't have a 401k in place, you can start an IRA, individual retirement account, and do the same thing where you're telling it to every month take X amount of dollars. There was a follow-up question there of automatically balanced each month. That's something different. So automated investing would be pulling money out of the bank account. The automatic rebalances would be set up by rules of whatever type of account you have. Some types of investments are rebalanced quarterly. Some type of investments like annuities, I can select that I want them to rebalance every month. Other types of more tactically managed accounts will automatically rebalance when they get to a certain drift. So if one asset class gets overweighted by 5%, for example, they'll sell off that 5% and purchase new companies to put it back in that asset allocation that we originally created. And that asset allocation is how many stocks, how many bonds are we going to have in your particular plan?
Thank you, Tori. So our next question is, I'm interested in putting extra money into a long-term investment incrementally. It seems like buying into EFTs such as SPY or DIA would be a safe way to do this. What are some downsides to things like this or other alternative investments that would accomplish similar goals?
I feel like I'm talking a lot, so that's why I keep like reining myself back in. So I'm like,
I can take it as well. I just was talking the last question, so I thought somebody else might want to take it. There's a few different questions in there. ETFs, exchange traded funds. I'm interested in doing it that way. So let's give a very common ETF. Like somebody might say, I want to put my money into the S&P 500. That is the largest, most successful 500 companies in the U.S. It's kind of it's an arbitrary list that's made each year and updated. The upside of ETFs is that they're not tactically managed. So that means the fees are low. So you're not going to pay as much in fees. The downside of that is they're not tactically managed. So there's not somebody watching over them and making adjustments maybe as often as you would like in order to have successful growth. And it's also missing all the companies outside of those 500 companies. So what about smaller companies? What about international companies? You're not, diversified in that example. So the other alternative investment that would accomplish similar goals. In the last probably 10 years, it's become very popular to have an active passive model for your portfolio, meaning half of your portfolio is filled with various ETFs, low in fees. You're not paying for management. Just kind of, let them sit and do what they do. And then the other half of your portfolio would be tactically managed. So then you kind of get the best of both worlds. It kind of keeps the overall fees, at a relatively reasonable amount. You also have some professional expertise tracking these and selling and buying shares as needed.
And as a follow-up, what are your thoughts on averaging down ETFs such as ARK?
I saw this in the chat. Big shout out to Catherine Woods.
Kathy Woods, yeah.
So, really quick of what ARK is and who Catherine Woods is. She's arguably one of the most influential people that are running ETFs in different funds. Her and her group, I play in their sandbox. They do a lot of investing in really bleeding edge technologies. They just released a fund where I actually have interest in investments where I consult in the space industry. So we are fairly bullish on all technologies on the end. I think a lot of traditional investments such as oil and gas, we have assets in Texas, are falling out of favor. We're seeing the rise of electrification, the rise of IoT, that's Internet of Things. And Catherine Woods and investment portfolios like hers that are managed through the ETFs have performed very, very well in the last 18 to 24 months. And a lot of people, and I feel the same way, is that they will continue to market on average. And by the way, last year, if you were a NASDAQ, so this is just blindly taking the NASDAQ, that performed 28.5%. So that's unbelievable during the year of COVID. So NASDAQ is traditionally a heavier invested in publicly traded funds and companies, organizations within technology arena. So we think that if you start putting investments in the technology arena, you don't have to go with someone specialized like Catherine Woods and ARK. You can just go with a basket of shares just following the NASDAQ. And it's performed traditionally very, very well over the last 14 years. But last year was just spectacular in a very challenging year. So it doesn't have to be too technical. Let the pros pick the stocks. Let the pros, they're the ones who choose the averages that bring up NASDAQ, the S&P 500, the Dow Jones. And typically, just going like that will beat quote unquote traders and will beat hedge fund managers. So Catherine Woods and what they're doing is a lot of people and myself are very bullish.
Yeah, it's interesting. I was reading an interview with her recently, and I think a lot of times, like some of the hesitation around ARK or companies or a philosophy around that is technology stocks have ripped, and a lot of times people have now deemed them to be overvalued or overpriced. Kathy Woods actually describes herself as a value investor, right? So that's like that old school Warren Buffett approach of like these companies that are a deep value. And people kind of heard her say that. I'm like, well, these companies are really, really like overpriced, based on their earnings. She said, no, but I believe the future of these companies is they're only just getting started. So there's deep value inside of these companies right now moving forward. But markets are cyclical, right? I mean, you look, the S&P and the NASDAQ have performed extremely well in the last, 5 years, 6 years, 7 years. If you look in the last 6 to 7 months, small cap stocks and value stocks have wildly outperformed those. So it's cyclical in nature. You want to make sure you have a diversified approach around these different asset classes.
Thank you. So what are education savings accounts?
Education savings accounts, there's a few different ones out there. The most popular one these days is the 529 plan. And that's where you are investing into a mutual fund, and that money is growing tax-free, and it comes out tax-free as long as it's used for education spending. It can be for tuition, it can be for books, computer, room and board, it can be for a trade school. If it's pulled out for a reason other than education, like a vacation to Hawaii, then you'll have to pay taxes when you pull that money out. But it's a great way to save for education, and it doesn't have to stick with the person that it was originally started for. So, for example, if somebody started it for their oldest child, and then that oldest child got a scholarship, they can change the beneficiary to the younger child, or they could change the beneficiary to themselves if they wanted to go to graduate school. So it does have some flexibility.
I think that's a key component, right? When I'm talking to clients, I don't recommend 529s that often, simply from a standpoint of flexibility and freedom to be able to spend the money however it is that you want, right? Maybe your kid, gets a full ride scholarship and you want to use the money for a wedding, for a down payment on a house, whatever it may be. And it's going to be, it's trade-offs for everybody, right? So like me personally, my philosophy is I would take the trade-off of, I'll pay a little bit more and not having the tax benefits to have the use of my capital, however it is that I want to spend it. Other people are different. So again, it's just going to be your own individual philosophy of where you fall there.
Yeah, and you can also use it for undergraduate education. So if you want to use it for private elementary school or private junior high or high school, you can use it for that as well.
IJ, are you saying something? It looks like you're on mute.
If I got too tall or too short in the image, you guys are all perfectly centered. I'm going off here. I'm just mumbling. Why does everyone look so good and I'm just in poor lighting or something? I gotta fire something.
You look fine. All right. So somebody mentioned earlier about housing prices being very high right now. Do you all think the housing market is in line with reality, or is it overinflated? What are your thoughts on that?
It's in line with reality because that's what it is, right? I mean, I think if you look at the stock market, or if you look at housing, it is a direct reflection of the, the mental state of the people in that marketplace. So, I mean, it's in line because, I mean, and then you've seen some outside factors too. Obviously, you're seeing a large influx of people into Southern Nevada, fleeing California, going towards, Arizona, Nevada, Texas, Florida. I think you could see actually even more California money flow into Nevada. Arizona recently raised their state income tax by about, almost 100%. So one of the appeals of coming to Arizona versus Nevada is now, becoming a little bit less attractive. So it's really, housing is always a, a very, very tricky thing. I mean, you would imagine that there would have to be some kind of pullback at some point. You've got, artificial market right now with the eviction moratorium out there. There's homes that aren't being paid on, that are not sitting vacant. It's not like 2008 where the banks were like, hey, man, we're getting our money and we're taking whatever it is that we need. I think, the political climate has changed to a point where you're not going to see necessarily the carnage of 2008. Will we see a pullback? Yeah, I mean, most likely. I mean, that's usually how things work. But I don't know if we'll see one to the degree that we've seen in the past. Now, that being said, probably in 6 months, the market's going to go down by 50%.
Although it will be interesting to
Travis is shorting the market, everyone.
No, this is being recorded. I just want to say that everything I'm saying is not direct investment advice. Please contact a professional, and past performance is not indicative of future results.
There you go. Well done.
So I want to say something too, is that, we do absolutely see an influx in people from California because the value is here in Nevada, if you want. But if they're willing to move, the question is sometimes when it comes to people who are located where people are moving, are you willing to move? There are places that have zero income tax, places like Wyoming where there's incredible value. Idaho, we talk about for the last 15 years. Now it seems that market is energetic. Part of Colorado used to seem very, very real. So where are those people? Where are the Colorados? Where are the Nevadans moving to? Where are the people from Idaho moving to? There is always value, but unfortunately, sometimes we get caught in the squeeze where, you know what, hey, listen, we want to stay here, but maybe it's not the right time for us to stay here. One thing that's really, really encouraging, though, they said that 85% of all work can be done remotely, opposed to, things such as labor, such as maybe bartenders, such as waitresses, and, some forms of labor, obviously, that can't be migrated to the work. But if that being the case, 85% of us can really, really work and live wherever we want to. There's other places that people will find value. And if not value when it comes to housing, maybe just you want to be in the desert for drier weather. Maybe you want to be near the beach, but maybe that beach isn't here in the United States. Maybe it's in Costa Rica. So, there's always value. And whenever there's migration, it seems like there's opportunity. So I just want to throw that out as well.
Thank you all. So our next question here is, do you think inflation will be on rapid rise considering the $1 trillion stimulus package that just got passed? What can we do to protect ourselves against inflation?
I just wanted to say one other thing about the couple that were home shopping. Like Travis said, there has been this moratorium about kicking people out that are not paying their mortgage. When that expires, there's going to be some movement. And when that movement happens, it could drop the housing prices. So pay attention to when those expire and just see what happens and see if maybe that might be a better time to enter the housing market.
So talking about inflation, so some of our positions that we advise in, we consult in, it is very, very sensitive to interest rates. That being said, we do not see that being an issue, even though it seems like the U.S. government has literally injected $1.9 trillion the last stimulus package, and obviously package 4, package 3, depending on how you say it, you're looking well north of $5 trillion. Proportionally to the GDP, and then proportional to our friends in Europe, China, and other parts of the world, we are being more fiscally responsible than the rest of the world. So that being the case, if the dollar is the reserve currency and we're doing okay, maybe not great, maybe we're doing maybe B- work, everybody else is doing C- work. So that's one way of looking at inflation. Inflation is only comparable, not just for the consumers where the environment in which you're working, but in which dollars or other currencies are traded against it. So we feel that organizations like the Euro, like Great Britain, these are major holders. Also China, the People's Republic of China, and Japan, really, and India have not been as responsible as the U.S. dollar. So when you talk about inflation, it seems like a lot because America is pretty rich. We're with the largest economy in the world. GDP is around $21 trillion a year. So a few trillion here and there, it's not as big, but it's big to me. I could use $1 trillion.
Pretty soon you're talking about real money.
Yeah, exactly. It starts adding up. But so that's one thing, even though it sounds like it, and a lot of people are parroting this, you have to really compare it to the other basket of currencies out there. And comparatively, the world banks out there, they have been a little bit looser with the pocketbook than the United States. So I think for the foreseeable future, there could be a rise in interest rates, but nothing that could be catastrophic.
I think you said the biggest piece there, right? As long as the U.S. dollar is the world's reserve currency, we're in pretty good shape. That changes, then a lot's going to change.
The other thing to keep in mind, if inflation goes up, if interest rates go up, like IJ was saying, with there's always an opportunity, like for where you want to live in the world for housing. There's also opportunities as things shift. We've been used to a very low interest rate for a very long time. Low interest rates are great when you're borrowing money, when you're borrowing money for that house, when you're borrowing money for the car, when you're borrowing money to go to school. Not great when you're trying to save outside of the stock market. So your savings account is really pathetic. I mean, mine's really pathetic. So I only have 3 months of living expenses in my savings account as an emergency fund. Everything else I'm putting to work. So, on the other side with interest rates, if the interest rates increase, then the cost of borrowing gets more expensive, but the value of saving becomes more meaningful.
Thank you all. So our next question here is, to learn about investing in the stock market, should one aspire to learn about fundamental analysis or technical analysis of the stock market? What are the advantages and disadvantages of each of them?
I'll let you two get into it a little bit deeper. I was just thinking, neither one of those I would think would sound attractive to the average person, fundamental or technical, unless you're like us and you geek out on this stuff.
Yeah, I was thinking the same thing. I think it's interesting when you start asking like questions like that's a really like intelligent question. I think it's like even that one step further than, you'll hear people talk about, active management or passive management, technical, fundamental. I think what you really need to do is there's no way I'm wading into like a political conversation, but I'm sure most of you know where you lean politically, right? Whether it's Republican, Democrat, whatever it may be. Just like I'm sure you understand where you lean religiously, right? It could be atheist, it could be Catholic, it could be Buddhist, it could be Muslim, whatever it may be, right? But you've got a fundamental philosophy around what it is that you believe. And I think that's what's really important that you need to establish. I think you need to do research on and see what really does appeal to me, right? Like I'll sit with some clients who, really believe in active management, that they believe that someone can pick and choose the best companies and the best stocks. And I have others who believe that that's essentially you trying to be a fortune teller, and they believe in passive management. So you've really got to establish, I think, we've got so many principles and philosophies and beliefs in all these different areas of our lives, but we don't have them from a financial standpoint. And I think educating yourself around these different things, because human beings are pretty instinctive. You're going to read something that's going to appeal to you, and you're going to be like, oh, that's me. Like that's who I am. And then you can go further and further down that rabbit hole of, learning more about what it is that appeals to you. I think that's just a lot of that's going to be self-study of, of what you really believe in. And I think that's important. I think finding out what you really believe in. I had a mentor talk to me years ago when I was a younger advisor. He said, you're going to have two choices as an advisor. You can be principled or you can be a chameleon. A chameleon's going to do whatever and say whatever it is they need to do to agree with the client. The principled advisor is mathematically going to know what works, what's correct, and they're going to stand their ground. And I've lost clients over the years because I'm not willing to co-sign on something I don't believe in. And so I think establishing philosophy and belief is the first step on all of that.
Thank you so much, Travis. Does anyone want to add anything to that?
I want to shout out there. I see Elizabeth. So Elizabeth, thank you so much for having me a part of this and putting this all together, running it. So thank you so much, Elizabeth. And am I pronouncing this correct, Miss? Is it Nevena? How do you pronounce it?
Nevena.
Nevena. So thank you so much.
Thank you. Pleasure. Well, we are towards the end of our time together today, but before we leave, thank you all so much for sharing your time with us today and for this very informative session and answering all of our questions. And thank you to the audience for joining us and for asking their great questions and for your engagement. I hope everyone has a great rest of your day.